Welcome back to Yahoo Finance Live. Waiting for the opening bell here. We have stock futures lower, Dow futures off 29 points. And just crossing the wires, eBay has a new CEO. They have hired the COO of Walmart's e-commerce division to head things up at eBay. So that's a stock to watch today. Broader market also lower. S&P futures down about 4. NASDAQ futures off 23 points as we move closer to a new trading week here at the New York Stock Exchange and the NASDAQ. Let's pause now for a look at the opening bell. There we go. A new trading day underway on Wall Street after that long holiday weekend. The S&P 500 coming off its biggest weekly gain since 1974. Looks like we're starting the day down with the Dow off about 90 points. I want to welcome to the show Ben Mandel. He is global strategist at JP Morgan Asset Management. We also have Brian Sozzi with us, along with Jared Blikre. Good morning, Ben. Good to have you with us. Just as in your role at JP Morgan Asset Management, I'm curious what you are doing with this stock market right now. How much cash are you holding, and where are you invested?
Thank you very much for having me. Good morning, everyone. Our role basically has two frequencies that we work with. One is our strategic time horizon, so we're trying to put together sensible and coherent portfolios over the next 10 to 15 years, right? So what is your benchmark in your portfolio? And on that score, you're basically shifting into equities here versus fixed income. So even before the whole coronavirus shock and recession and what we're going through right now, you had a period where safe assets had rallied very significantly. So it's hard to find a model out there that doesn't show bonds and treasuries in particular as being super expensive right now. And so the trade-off between equities and bonds was suggesting pushing more into equities. And of course, what we've seen over the last month or so has only served to reinforce that. You had a continuation of the big rally in safe assets. Equities obviously have become less expensive than they were. And so on that really long-term horizon, and maybe this is the more straightforward implication of this all, you're shifting from fixed income into equities. I think where that gets more difficult is the tactical time horizon. So if you're trying to figure out what to do over the next 12 months versus the next 10 years, it's trickier. And in fact, you have a lot of countervailing forces pushing in the opposite direction. It's very unusual for equities not to retest their lows after a drop that we've seen, a similar drop that we've seen to the one over the past month. And moreover, it's not as if we expect bond yields to go through the roof, even when we see signs that the economy is stabilizing. And so that equity risk premium, which is very wide in the long term, is a little bit narrower in the short term. And so you're not pushing as aggressively into equities in the near term.
Ben, interested, a real good read by our Sam Rowe this morning in our morning newsletter, just talking about how difficult it is to value stocks. How are you valuing stocks right now? Because I think a lot of people on the street would argue we're in for at least 2 quarters of earnings that are just mind-blowing declines. So do you just toss out 2020 and just focus in on 2021?
Yeah, I mean, that's a really good question. I mentioned that equities have become less expensive. It's hard to say whether they're outright cheap or not because we only see the price. We don't observe the earnings. And in fact, there's a tremendous amount of uncertainty about that earnings profile. Taking a step back and looking at what the economy is doing over the last, currently, you could have anywhere between a 20% and 40% annualized drop in second quarter GDP. And so that quarterly measure is very dramatic, and you don't see the level of GDP really coming back to where it was prior to that before 2021. And so there's a very V-shaped nature to the contour of quarterly GDP, but a kind of U-shaped nature to the annual rate. And that's, of course, what the earnings are based on. We think about earnings a little bit more on that year-over-year measure, which is going to look bad this quarter and is going to look bad for the next 4 quarters. And so I don't, I think it's fair to say that prices have come down. Have they come down commensurate with earnings? I'm not totally sure. What we can say, though, is equities relative to bonds look a little bit better.
Yeah, and Brian, you actually had a report out over the weekend on our site talking about our earnings season and GDP estimates and how some Wall Street firms are saying we could see GDP negative 25%, negative 30% in the second quarter. But I want to also get to some news we've got out on General Electric this morning. I know you follow that stock closely. What do you know, Brian?
Yeah, second straight week of bad news at GE. Just keep in mind, Alexis, last week they came out and warned that first quarter will be materially below their prior outlook. This week, GE coming out this morning, just hit the wires, saying they are looking to launch a strategic debt issuance to fund a tender offer for GE bonds maturing through 2024. Also looking to further reduce their debt and looking to launch another tender offer targeting up to $9 billion of debt maturing in 2020. I think GE will, this type of announcement reflects what you'll see largely across corporate America in the coming weeks. A lot of these companies have significant debt coming due. And I think for a lot of big companies in corporate America, they're going to have to use their balance sheets, look to repay this debt as fast as possible and roll it over into some cheaper debt because revenues aren't going to be there, sales or profits aren't going to be there. They have to figure out a way to protect earnings and cash. And one way to do it is completely overhaul their capital structure.
Ben, jumping off that, do you think this is a harbinger for other things to come from some large S&P 500 companies? Are they going to take a page out of GE's book here?
In a sense, leverage was one of the chief concerns prior to this downturn, in the sense that over the past 10 years, capital markets have been open, interest rates have been low, and firms did their best to lever up. I mean, it's a perfectly rational response to that set of conditions. And so what we're seeing now is a very negative interaction between the shock and the high leverage of firms. I think really that's a question that the Fed has been mulling over, and in fact is the main reason why you've seen them aggressively expand both the breadth and depth of their programs. So, the Federal Reserve is not usually in the business of credit allocation, but it was sort of forced into it during the global financial crisis and is at it once again. And so acting as a liquidity backstop for corporates and starting with investment grade, but they've been pushing sort of into fallen angels, aspects of the high yield market as well. Really what this is going to come down to is the monetary policy backstop for liquidity sufficient to bridge from now until when things get better? My guess is that at this rate it will be, because we've seen a very, very quick expansion of programs and a willingness to do more as necessary. So I think it's a harbinger of more monetary policy action to come, and perhaps the Fed working its way down the capital structure from the highest quality and into the lower quality over the next month or two.
Jared, it looks like the selling momentum is gaining some speed here in the early going. What are you looking at?
Well, I'm not seeing too much selling pressure just yet, and we'll look at some charts on the Wi-Fi Interactive here. We're going to take a look at the Dow heat map first up, and you can see kind of a mixed picture, probably more red than green that we're looking at here. Tech is slightly outperforming, but we can see in the upper left, Microsoft down about 0.25%, Apple up just better than 0.33%. Walmart, staple, is a standout, kind of in the middle there at 2% up. And just looking at the NASDAQ as well, we'll see some more movement. We see Alphabet down just slightly, Amazon up better than 1%. If we sort by performance, we can see eBay, which we've been talking about, getting a new chief there. That's up 2%, along with Tesla and Gilead, some of the more defensive names that we've seen in this coronavirus crisis. Kind of interesting to throw Tesla in there at this time. But if you look in the lower, the biggest losers here, the airlines down. United is down nearly 5%. Expedia and Marriott, those are both travel plays, down 4% and 3% respectively. Just kind of slow going here, but still inside yesterday's, or at least Thursday's, range in the S&P 500 last I checked. So here are our sectors, and we can see energy and staples are the only ones in the green.
All right. Thanks, Jared. We also want to thank Ben Mandel, Global Strategist at JP Morgan Asset Management, for joining us this morning. Be well, Ben, and thank you.
Thank you.